Hi, Jan. Is the disappointment over what Mario Draghi did yesterday priced in completely, or should we expect more sell-off in the European markets?
No, I think yes. Well, I think it's not priced in completely. I think investors are positioned very wrongly in respect to this. This is one of the most heavy consensus trades towards the year end that we've seen for a very, very long time. Everybody was expecting Draghi to be more dovish than he was, and are positioned accordingly. So there's a lot of pain going through the market now. I think it's interesting how badly the markets have misinterpreted the ECB. In my opinion, the ECB's easing program is directly related to Mario Draghi's expectation of how much Yellen at the Fed will tighten monetary policy. Basically, the easy monetary policy by the ECB is a defense against high interest rates in the United States. So when Draghi comes out and delivers less than expected easing, which was the case yesterday, it is probably a reflection that the Fed is not going to tighten as much or not going to be as hawkish as the market has been expecting. So I think what we're going to see is that by the time we get to the 16th of December, we're going to get a very, very dovish hike from the Fed, and I think that's going to breathe life back into the global risk trade. So I think this is the gap we have between right now and December is actually a really good buying opportunity, in my opinion.
Right. So how much lower do you think we can get from here, considering you did say that it is not being priced in? And once the December 16 comments come in, how much higher do you see the European markets going from here?
Yeah, that's an excellent question. There is, of course, a little matter of an OPEC meeting, and particularly a non-farm payroll today. And I think those two factors are going to be very important. The nightmare scenario for current investors, given positioning, which has been all wrong, it would be that we had a hawkish statement from the OPEC, meaning that they actually cut output, and at the same, which would put further upward price pressure on oil, and therefore downward pressure on the dollar, and therefore push the euro up. And also, if we had a weak payroll number, that too could push the euro higher, and that would inflict even more pain. The problem for stocks is not that these decisions actually have a lot of impact on the real economy. The problem for stocks is that people have positioned themselves in the bond market in the wrong way. So people were basically expecting the Fed to be quite hawkish and the ECB to be quite dovish. So people have been shorting short-dated government bonds in the U.S. market in particular, but also in the European bond market. And now they're going to have to buy back these short-dated bonds, and the way to finance that, unfortunately, is to sell the long end of the yield curve. So you're seeing long-end yields going up, and that, of course, is extremely painful for the economy, and that's what's killing the stock market. So if we get a soft payroll number, and if we get a cut in output of oil by OPEC today, then you should expect to see euro-dollar go significantly higher. You should see a further sell-off in the long end of the yield curve and a worse near-term outlook for stocks.
Okay, Jan, we'll leave it at that. Thanks so much for joining us with